One of the biggest lies banks tell us is that our money is safest when kept with them. The reality is, while your balance increases with interest, inflation is silently eating away at its value. As one leading actuary put it, holding cash in a bank is like standing still in a race. Where the competition is inflation, you're guaranteed to lose ground. In this video, we're revealing 7 assets that not only protect your money from inflation, but also help you build lasting wealth for generations to come. Number 1. Precious metals. The timeless appeal of gold and silver. Gold and silver have been valuable for thousands of years due to their rarity and durability. Though they are no longer used for everyday payments, they still hold high value, especially in uncertain times. During economic crises, gold's price usually rises, and in 2024, it has increased by 12.7% so far, making it one of the best-performing assets worldwide. Investors worried about recession and global tensions have turned to gold for safety. Central banks, notably in China, Turkey, and India, boosted their gold reserves by 290 metric tons in early 2024, a record increase not seen since 2000. This shows gold's reliability as a stable store of value. Silver, cheaper than gold, has its own strengths as both an investment and an industrial metal. It's used in electronics, solar panels, and other technologies, driving a potential increase in demand and price. In 2024, silver could reach $30 per ounce by the year's end, with optimistic forecasts as high as $48 per ounce by mid-2025. Historically, silver has often outperformed gold during market upswings. Analysts from JP Morgan, Citigroup, and Commerzbank predict that silver's price will increase as interest rates drop and industrial uses grow, particularly in solar energy. Number 2. Real estate, a powerful tool for building wealth. Real estate is one of the best ways to build and keep wealth. One big advantage is leverage. You can buy a property with just a small down payment. With $60,000, you can buy a $300,000 property and gain from the full value increase. Not just your initial investment. In 5 years, this can give you a 44% return compared to 36% if you paid in full. When inflation rises, so do property values and rental income, helping your investment grow. Over time, inflation also makes your mortgage feel smaller while your property's value increases. Besides growing in value, real estate can provide rental income and tax benefits. Rent usually goes up each year, and you can deduct expenses like mortgage interest and property taxes, which lowers your tax bill. A $300,000 property can generate nearly 30% returns by the 5th year. Unlike stocks, real estate is a physical asset you can see, manage, and improve. As you pay down the mortgage, you build equity, which works like a forced savings account that grows your wealth. Even small investors can grow their portfolios with leverage. Number 3. Real estate investment trust. Simplified real estate exposure. If you're interested in real estate but don't want the hassle of managing properties, consider investing in real estate investment trusts. REITs are companies that own income-generating real estate, like apartments, offices, or warehouses. They let you benefit from real estate without the work of property management or dealing with tenants. As of 2021, almost 45% of US households invested in REITs, showing how popular they are. A big advantage of REITs is their high dividend payouts. By law, they must pay 90% of their taxable income to shareholders. In 2021, REITs paid out around $92.3 billion in dividends. They're also easy to trade since they're listed on stock exchanges. As of May 2024, equity REITs had an average dividend yield of 4.2%, and mortgage REITs offered 12.5%. Number 4. Dividend stocks. Earning while you hold. Dividend stocks let you earn a steady income while holding your investments. They pay out regularly, even when the market is up or down, making them a good option if you're looking for a reliable income source. These stocks usually come from strong, stable companies, so they're less risky. The big plus: consistent payouts. Even in tough markets, many companies prioritize paying dividends, showing financial strength. Some even increase dividends over time, like dividend aristocrats and dividend kings, which have raised their dividends consistently for 25 and 50 years, respectively. This means you could earn more as stock prices grow. On top of that, dividends often get taxed at lower rates than regular income, saving you money. These dividends are taxed at long-term capital gains rates, which are usually between 0% and 20%, offering significant tax savings compared to regular income tax rates, which can go up to 37%. Number 5. Diversified index funds or ETFs. Why own one stock when you can own them all? Many people try to beat the market by picking stocks, but it's much harder than it looks. For example, while Amazon gained 343% and Apple 469% over 5 years, AT&T lost 33%. The S&P 500, on the other hand, returned an average of nearly 14% annually over 5 years. By investing in an S&P 500 ETF, you're buying into 500 of the biggest US companies. If one sector struggles, others can still help balance your portfolio. If you had put $10,000 into an S&P 500 index fund 20 years ago, you'd have over $55,000 now. This steady, long-term growth is why index funds and ETFs are safer than picking individual stocks. Plus, they have super low fees, often under 0.1%, which means more money stays with you, unlike actively managed funds that can charge over 1%. For October 2024, some of the top-performing ETFs include the Invesco Golden Dragon China ETF, which jumped 15.14% thanks to China's economic boost, and the iShares Convertible Bond ETF, which gained 2.4%, offering a mix of stock-like growth with bond safety. The Invesco Emerging Markets Bond ETF had a 2.54% return by focusing on bonds from developing countries. On the commodities side, the United States Natural Gas Fund led with 15.2% due to rising natural gas prices. Number 6. Pension funds or retirement plans. 401k IRA, the magic of compound interest. While diversified ETFs offer a balanced, low-cost way to grow your wealth, there's another tool that can supercharge your savings over time: your retirement plan. Setting up a 401k or IRA is one of the best things you can do for your future. Relying only on Social Security probably won't be enough to maintain your lifestyle when you retire, so building a retirement fund is key. By early 2024, Americans had $7.8 trillion in 401ks and $14.3 trillion in IRAs. These accounts aren't just for saving. They let your money grow through compound interest. For example, investing just $100 a month from age 25 could give you $91,000 by age 60 with a 7% return. A big advantage of 401ks is employer matching, which is like free money. If your employer offers a 50% match up to 6% of your salary and you earn $50,000, contributing $3,000 a year gets you an extra $1,500, making your total $4,500. Over time, that adds up fast. You also get tax benefits. With a traditional 401k or IRA, your contributions reduce your taxable income now, and your investments grow tax-deferred. With a Roth IRA, your investments grow tax-free, so you pay no taxes when you withdraw in retirement. On average, a 401k returns about 9.7% annually, while a traditional IRA grows at an average rate of 10.8% annually. This beats inflation and helps your savings grow. Number 7. US government bonds. Safe investments starting at $25. Although 401ks and IRAs are excellent vehicles for building wealth over time, some investors may prefer options with even lower risk. In such cases, US government bonds provide a safe and steady alternative. With as little as $25, you can buy electronic Series I or Series EE savings bonds directly from the US Treasury. You can purchase bonds of any value above $25 with a yearly limit of $10,000 per person for electronic bonds. These bonds do not pay regular interest but instead accumulate it, compounding every 6 months, and you receive the interest when you cash in the bond or it matures. Treasury bonds are among the safest investments available, being backed by the US government, which has never defaulted on its debts. During uncertain economic times, government bonds offer a reliable way to protect your money while earning modest returns. Series I bonds have a variable interest rate that adjusts for inflation every 6 months, currently at 4.28% as of October 2024. Series EE bonds, in contrast, have a fixed interest rate and are guaranteed to double in value after 20 years, regardless of the market, meaning a 100% return over that time. Interest earned on US government bonds is exempt from state and local taxes, and federal tax on interest can be delayed until the bond is cashed or matures, with potential tax advantages if the money is used for qualified educational expenses. That's all for today. Don't forget to leave a like and share it with your friends. Tap the screen to watch more videos like this. See you soon.